Good afternoon, everybody. It's Dave. It's around 1:20 in the afternoon on Tuesday. And you can see we have a rally going on. We're looking first, though, at the dollar. Dollar continues higher. It opened lower. But the news today really reflects the idea that Greek parties, the conservative bent, have gained in popularity according to opinion polls, which means that for the election coming up on the 16th, I believe, things will be better. But then again, what's really going to happen? Some say they will exit no matter what happens in terms of their commitments. And Spain is still causing a lot of trouble insofar as their banks are concerned. So here we are with the dollar kind of still higher again, even though stocks are better. Let's take a look. Stocks rallied sharply early on the day and are now still positive looking at the S&P. So we kind of expected this, given that you have a 3 or 4 day break in the action and people's memories are really short. So if you looked at, as I had indicated in my weekend commentary, if you looked at the McClellan Summation Index chart that I posted, you could see that we were much oversold even on an intermediate term, and we've been posting a lot of oversold indicators recently. The news today, other than what we just discussed regarding the Eurozone, was that home prices were flat, which isn't that encouraging, frankly. As a matter of fact, home prices are down 35% since the 2006 high, according to the data, and this is probably with the exception of Manhattan penthouses and property in and around Washington, D.C., where the money is. Consumer confidence data today was weaker than previously. I like this consumer confidence data better than the consumer sentiment that came out on Friday, which is much geared towards stock prices and gasoline prices. Consumer confidence that we looked at today, the data this morning, was not that positive. As a matter of fact, it was much weaker than expected, and that probably paints a truer picture because it's more weighted by jobs. Here's XLK, the technology sector. It's up modestly on the day, not a bad day, not near the highs of the day certainly, and we'll see what the afternoon brings. But we've broken above this 10-period moving average on the daily charts, and you can see some of these daily indicators are turning higher. Well, despite poor data today from consumer confidence and earnings overall, which have been quite mixed, consumers' discretionary sector still remains strong and has been in this rising trend, of course, since we exited naturally. But what you understand about this sector is not dominated by what you may think. It's dominated by McDonald's, Amazon, Disney, Ford, companies like that. It's not dominated by J.C. Penney's and Sears, for example. Well, even with the poor consumer confidence data and with home sales data and price data being poor and housing starts all of last week being not that great, we do see home builders, ITB, up on the day once again. And it has been quite a yo-yo ride here over the last couple of weeks with home builders. Big moves in either direction. But we're up again as a lot of people, a lot of pundits are calling for a housing bottom. Bonds, on the other hand, they continue to move higher. Even the stocks are higher. I guess people just don't trust the alternatives for fixed income investing from sovereigns like the Eurozone. And that's all you can say about this because you're not making any yield at all. It's really ridiculous. Well, gold once again is lower. Very choppy here at this bottom that looks like we may have reached around last week sometime. And we're down today. Why? Because stock markets are higher. The dollar naturally is higher. And of course, that's bearish for commodities overall and gold specifically. But I'm thinking that eventually we're going to decouple that relationship, particularly if something happens to the euro. You may think it bullish that prices are down for commodities, but this DBC chart says it's really not bullish for common stocks. With the dollar higher, prices for base materials and all manner of commodities is not a bullish thing. It would be better to see it higher, but not trending dramatically higher, but at least with some stability. This is a sign of economic weakness. Well, let's see. We're looking at USO, which is the U.S. oil fund. See, we had a DeMark 9 here on the 15th, which really didn't slow it down hardly at all, this descent. And that's what happens sometimes on dailies. And here we are with another 9, and we're heading lower. And obviously, consumers probably like this more than than anything else. However, it is also another sign of economic weakness. Here's the China ETF, FXI, and I'm going to wrap it up there. China is contemplating adding $350 billion in stimulus to their economy through whatever measures they deem, whether it's quantitative easing and open market operations and buying bonds and whatever, or reducing bank reserve requirements. And I think that's quite possible, but that's seen as very bullish. And I think what's causing the U.S. market to rise today certainly is that we've had a series of bad data. Markets have not been that good overall, and the Fed meets on the 20th, and everybody believes that they will be adding another quantitative easing round. We'll see what happens in that regard. Have a great day. See you this afternoon with Dave's Daily.